Hello everyone, TNS Kruger here. Yes, the webinar comes online with a webcam. TNS Kruger here, the FX trainer for South Africa for Forex Time. Welcome to this webinar. Today we're going to do a live analysis. Just want to double check if you guys can hear me. Everything from my side looks fine. Okay, Ryan, Owen, yes, some familiar names here. Welcome, guys. Right, okay, so you can hear me. So I'm going to continue. Right, today we're going to do a live analysis again, moving average spring strategy. Some guys said, please, I must spend less time, giving some background and more time just exploring and looking at examples and so on. So today's going to be very practical, just a very, very short 5-minute introduction. And the reason why I do that is always, guys, if we move away from the basics, then we're done. So if you don't know to understand what the foundation is, if you don't understand what technical analysis is, that the underlying structure, the initial stages of the next trend, if that is not what you're looking for, then you're not doing the basics, and then at some stage it's going to stop working for you. If you focus on the indicators, even this moving average spring strategy of mine, if you focus on the indicators and you take your eyes off the king of the price, then you are looking for trouble. So that's why I always go back to the basics, even if it's just a couple of minutes. Now, just to emphasize the fact, is to show you that it's everyone. Some guys I know, especially a guy that trades the London Open, he's got a strategy there. Every time before his session, he starts about 15, 20 minutes before, and he goes back to the old charts, and he just like a sharpshooter, trains his eye just to see that early stages of the next trend, the way his specific strategy applies that. So he does it every single time. And just to repeat again, just from another sector again, at one seminar we had a commercial pilot, and he said every 6 months they have to go for tests, simulated tests and theoretical tests on the basics. In any business, if you stray from the basics, you're done. It's just a question of time before you lose your way. Right. So what is the basics? Let's move on. The basics is, of course, what technical analysis is. We need to see in any time frame, doesn't matter what instrument, what time frame, we want to see that structure. And we just always in the beginning tell the guys to practice just with a clean chart and just trend lines, just to see that structure. And of course, the early stages of the next trend, the sweet spots, that's where we're going to look. Just to overlay that for you, to explain to emphasize for you how important that is, I've put I've got just a clean chart with our trend lines showing us the structure or the trends, and this is the overlay of our method. This is the moving average spring strategy, and you can see there's the areas we're looking for. There's the sweet spots. It's the early stages of the next trend. Right. Okay. So every webinar I do, I always, let's just go to a quick review of that. I always, because of guys that are new, just quickly look at what we're looking at. Right. We've got a 34. We've got a 15. We're looking for the price to cross to go through, to break the 34, to pull back, to make a fractal indicator must show us a breakthrough there, must show us a fractal, a reversal point. We must come back to the 15. We don't need necessarily a fractal there, and if it breaks the up fractal, so it broke through the initial stages of the new trend. Pulled back, helps us with our risk management. Breaks up, then we enter at that fractal, when it breaks past that fractal, that enables us to use stop orders to enter. So we don't have to sit and wait, especially with the longer term charts. That's useful. So entry, our stop loss is very simple, no guesses, no wondering. It is the 34 moving average, where it is at that stage. That's our risk. We do lot sizing. Very, very important. If you guys don't know what lot sizing is, I've discovered quite a few guys with the Skype sessions that they're not sure what lot sizing is, and they're trading with way too much or too little lots. Then you must just tell me so I can work it into one of my we can quickly discuss it here as well. So if you have questions about that, just list it for me or put it there. Right. Ryan asks, period of 2 moving averages. Yes, I just repeated or just said. If you're not sure, you can always go and look at the recorded webinar I've got, the introductory one. You log onto my FXTM, go to webinars, and there's a recorded webinars. Actually, there's a couple. There's the moving average spring strategy. That's the introductory one, and then there's already one there, also a little bit more application. Right, I've got the 34-year simple moving average and the 15-year. We've got our entry there. Our money management, we take 50% at 1-to-1. So if our risk there is 10, 10. We take our first reward there, 50%, and it's a break-even trade, and then the rest of our take profit we take there. Right. Very quickly. So that's done. Some guys said I use too much time for this, so I'm spending less time on this one. Right. So there we've got our underlying structure, technical analysis. Here we've got our overlay. All right. So let's look at a couple of examples before we go to before we start roaming around. All right. I've changed. I've customized my Fibonacci to help me with very quickly to be able to check, what is the price at the different places I want to put my stop loss at my take profits and so on. So if you I'll explain that a little bit later too if you want. Does anyone want me to explain how to change your Fibonacci? Because it's not a standard Fibonacci. So if you want to, then you can just tell me now and I'll quickly do it. Or if you know how to work it. Okay, Philip asked that I explain quickly. Right, it doesn't take a long time. So what I've done is I've set the settings here for you. So you can quickly take a screen print if you want, and I'll show you how to apply it. We're going to change our Fibonacci from a standard Fibonacci settings with the 50% and the extensions, the 161 and the 38 and so on. And this is what we're going to do there. So if you want to take a screen print just for later. Okay, bring that up if you ask again. Let's go and look what we do. What we do is when you bring up, obviously yours is going to be a normal one. And the normal one looks like that. Let's go to the defaults quick. That's how your normal Fibonacci is going to look. We want to change that. The 0 stays the same. We're going to put, I'm just going to copy and paste there. Okay, we're going to copy and paste that in there. So I'm going to write stop loss and a few spaces, then percentage and a dollar sign. And you'll see what that causes then. Paste it in there. And when I say yes, what that causes is it changes that, it gives me a description for my stop loss is going to be. That's would have been the 0. And then, of course, what I want the price to be. That's very handy when you use stop orders. Okay. So let me do the rest of them as well. So this one I'm going to delete. I'm not going to use the 23, another 38, 50, delete all those ones. So 1, we're going to use again. Just copy it there. And paste it in. Then I've got my entry. And 161 I'm going to delete. Or no, I'm just going to change it to 2. And that one I'm going to change to 3. And then with the take profit, I'll just paste that in there. once you get used to it. Luckily, when you've changed it, it's actually just my take profit 2 there. So I'm just gonna paste this one here and change it to 2. When you've done it, that it stays the same. So and of course, then I'm gonna delete that extension as well. So this is the settings there. 0 stop loss, and obviously to get the price there, I put the percentage and the dollar sign. 1, 2, and 3. And what that causes is a very, very handy tool to be able to, like for instance, what we're going to do here. Here you can see we've got our first example. We've got a break through the 34. We've got a pullback to the 15. I'm going to put my entry here. Let me illustrate that from the top or from the start. What I do is I click on my Fibonacci. That's where my entry is going to be. I drag it to where my stop loss is going to be. 34, no guessing, just the 34. And there I've got a precise setting of how much my stop loss. You can just quickly check what my stop loss is there. It's going to be about 21 pips. And then I know what the price is. That's my stop loss. That's my entry. That's my take profit 1. That's my take profit 2. Obviously, here it went very well. So quickly. Okay, did everybody understand that? Hello, Vanessa. Did everybody understand that? Can everybody do that? Mustafa asked, can you please repeat which EA did you put? Right, I don't want to go too deep into that. I'm going to quickly repeat it, but what you want to do is you want to go to log into your My FXTM, go to webinars, education webinars, and then you can watch precise. Let me show it to you quickly, guys, because I see there's some guys that are new here. What you do is you simply log on to your My FXTM. Oh, I see caps locks on. That happens. Almost done here. And I see there is questions. I'd like to address them. Right, you go to education, log on to your site, you go to education, myfx.com, you go to webinars, and then you scroll down until you get to the recorded webinars. Now here's a practical one as well, moving average strategy part 2. That's a little bit more practice in. But just down there's the first one. So it's going to explain to you, Mustafa is going to explain exactly what we use, how we use it, and give you a little bit more of an introduction. So this one I don't want to focus too much on that. I want to focus on application. So right, so we've got everything set. We've got our template here. We've got our quick, easy way to see what our stop loss is going to be, where our take profit is going to be, to just do that. And this is back testing. So this is training your eye, training that neural networks of yours to be able to do this. Right, so that's our first one. Like I said, that's the 34 simple moving average. There it is, and that is the that's the 16. Sorry, must be 15. Simple moving average. Right. I'm going to just have to save that template of mine again. Right. Okay. So there we have it. So let's go through these ones as well. Let me read one. Okay. Philemon said that he didn't understand this template or the way to do the Fibonacci. Like I said, you open the Fibonacci, it's very quick. It's going to be standard, and then you simply change those at the Fibonacci settings. You change those to instead of the normal ones, you can delete the normal ones and just put a 0, 1, 2, and a 3, and then you type in those that there, right? Those that descriptions there, stop loss. If you don't understand, just take my email and then you can email me and then I'll send you a recording of this. You can just watch it again a few times, right? Okay, let's get on with the practical stuff, guys. Right. So we had our first example. We had a nice breakthrough to 34. We had a pullback, and we had our first trade there, and it took us out, or it took all our profit, gave us all our profit. So now we wait. There's nothing to do here. Nothing stops you from going to a lower time frame or to a different currency pair to go and look for other beautiful uptrends, beautiful downtrends, and then the initial stages. But on this specific chart, we've taken our profit here, and this is done. So we wait. Right, so now we wait for the next one. Here the market comes up, down, some ranging going on here. We have a break above, we have a pullback. I don't like that pullback that's so very down there, but it didn't close. It didn't close down there. So it closed above this. So what are we going to do next? We've got our breakthrough. We've got our beautiful fractal. That's where we're going to enter. At the 34 moving average, that's going to be where our stop loss is. That was our entry. Let me blow it up a little bit for you. Zoom in a little bit. That's where we had our breakthrough. That's where we had our pullback. That is a spike. So it didn't close below. If it closed below there, I wouldn't ignore that one. We put our entry here. It went up, came back. That's normal. Some guys tell me it feels like a conspiracy theory. Every time, just after they entered, the market pulls back and then they close the trade out. There's no conspiracy theory, guys. It's just a natural movement of the market, the trending, the waves of the market. So what you have to do is to train your mental frame, to train to see this underlying structure, to apply your simple, well-defined method, to apply your money management, to practice that over and over until you get used to this. You don't panic when it pulls back. You know, over a series of trades, this is just the way the market moves. And here you can see it again. Engaged as there, it went up, came down, took our first take profit, break-even trade, came down again, and then took our second take profit. The only reason why we've gotten out of this trade, we would have left this. As you can see, it's above the 34. So the trend is in, it's a bit of a ranging market there, but it's still above that one. There's no new entry there. As soon as we get a new entry, and that's what happened here, we got taken out there, so we had all our profit. But sometimes what happens, it doesn't reach that second take profit, and it starts turning around here. And what happens here is we're looking for the next trade. So let's delete this one. Right, so where's the new trade here? Here was a breakthrough and pulled back way back. That's not the beginning stages of a new trend. That is could just be a range. So remember what we want. We want a breakthrough, a decent breakthrough, and then a pullback to the 15. Not too, it mustn't break too far behind the 15. So that one is not a valid one. Broke through again, it broke through too far. Here it broke through, gave us a nice fractal or a turning point, possible turning point there, but it didn't pull back very nicely, right? So I don't like this one. So it did give us a little fractal there, but a nice pullback there would have helped us, would have just confirmed the market structure. Something is not right here. There was no pullback, so I just would have left it. And I've had some questions about this also. What if it makes another one just a little bit lower? Now I want to explain something very quickly. I think there I can show it actually more easily. You can see what's happening here. There's a lower bottom, a top, a lower bottom, top, a lower bottom, top. That's the definition of a trend, as you guys know. Right. So what are we looking for? The beginning stages of the new trend. So and the term we use for these the waves is we have a longer wave, in this case a longer down wave. We call it the impulse wave, And then we have a pullback or a correction wave. Impulse wave, correction wave. Impulse wave, correction wave. Impulse wave, correction wave. Until until there's a wave or a series of candles that goes higher than the previous stop. So in this case, this is where it breaks through 34. This is our next. This is the beginning stages of the next trend. All right. So we've got a wave or a next impulse wave here. That's our first impulse wave. There it goes. It goes higher than the previous top. We've got a pullback, a correction wave again. And this is, remember, this is where we entered. So we entered here, the first impulse wave, corrective wave, the second one. We entered on the second one. Now this strategy is designed normally under normal circumstances to enter on the second impulse wave. It's a little bit delayed. The professor's strategy that he uses at the seminars, the failure swing, uses the first one. So it's a little bit earlier than mine. So that normally gives you a little bit of an early entry. And some people like that. People differ. So some people like a little bit more risk, some don't. I designed this one to take the second one. But the moment you go past the second one, then you're looking for trouble. The reason why I say this is normally, again, it's just an average. We have one impulse wave, corrective wave. One second impulse wave, corrective wave. A third one is normally about 3 to 4 impulse waves at least on average in a normal trend, right? So if we catch the first or the second one, and in the strategy, the second one, then it gives you, like in this case, the chances are very good for you to reach your first take profit, right? And remember, the first take profit takes all risk away because you're going to take 50% of your profit. So it's a no risk trade anymore. You're not going to move your stop loss until the signal comes. And then you move your stop loss where the entry of the next one would have been. So, or when you're sure, this trend is not the uptrend anymore, then you can move your stop loss. Until then, your stop loss stays there. So you give the market room to breathe. That's very, very important, guys. I can't tell you how many traders, and I've also had that experience for a long time. It's almost like you can't leave the trade, so you start moving up your stop loss in the market. In this case, what would have happened if you moved your stop loss? It just takes you out and then it goes, and it's very, very frustrating. So that's one of the reasons you have to practice this on old charts or historical charts so many times, is to show yourself, to prove to yourself that I can leave it. Over a series of trades, if I leave it, it will give me a net profit over a series of trades, because this works. This underlying structure is human behavioral patterns. It's people buying, selling, and people sitting on the sideline. All right, so let's continue. So just to very quickly recap, we're looking for the second impulse wave. So what happened here? There was a bit of a range. There was our first one, first decent one anyway. It wasn't a nice pullback, so we didn't enter this. We didn't catch the second down move, the second impulse wave, and then we leave it. Because normally at the third one, it's very close. It's close to consolidation, and your chances are the probability of it hitting your first target and you having a risk-free trade is getting lower and lower and lower, right? So we leave that. We didn't get a good entry there. Okay, does everybody understand that? If you have any questions, just post it here. This is a practical thing. I'm not running through a presentation here, so this is to help you guys to be able to practice on your own. You can watch this later again, see how we look at this, see how we reason. That's one of the problems I have with guys that buy a system or that think a method is what it's all about. They don't understand what's going on underneath it. They don't have understanding. So just for instance, the first and the second, the third impulse wave. So many people get involved in the market only at the third impulse wave, and they're expecting profit and it doesn't give them, or just the market starts piffling and then they don't know what to do and they get stopped out and they get frustrated. If you understand a little bit about the structure of the market, then it helps you. So, okay, here we've got another setup coming on here. Let's see what happened here. Remember now the impulse waves we talk about. So there was a lower top, there's a lower or lower bottom there, lower top, and here basically the new trend started. But there was a lot of volatility here. So our method kept us out of this one. This is there's a few things that played their part. The first was it was underneath there. Remember, we were waiting for a breakthrough to 34, and it was also underneath the momentum. So the momentum I don't use. I just like to use confirmation. Normally, when it's below here, then let's just check it. That one, yes. Normally, when it crosses the 34, then the momentum also starts adding up, or the momentum also crosses there. So I just glance at it very superficially. But in this case, things are definitely warning us, no, there's too much volatility here. There might either a range happen here. We want this many sellers to commit here. That's part of the foundation. That's part of understanding what's going on. We want a lot of sellers to commit here. And this shows us there might be some sellers here still that want to enter the market. We want all the sellers to commit, no sellers to be on the sideline, and then the buyers can start coming in. So with this volatility, we're not sure. So it kept us out of here. So here we have a lower top here, couldn't go lower, and here's a higher, with a higher bottom, a higher top, near the impulse wave starts. All right, so there's 1, 2. We would have liked to enter into this one. This would give us a good probability that at least our first take profit would be reached. Doesn't happen, still too low. It's only starting here, so I don't like that. What we're looking for is easy setups. It must just be easy, right? We're not trying to overtrade. We're not trying to push the market to give us something. So we left it. We missed this one. What is nice about this method is you don't have to specialize in one currency pair. It's very easy to open to analyze a lot of charts. So, or very quickly analyze charts using this. It's very easy to see where the market is. So, if for instance, we open up a chart and we're there, there's nothing to do. We look at the next chart. So you can, in 2-3 seconds, when you open a chart, you can actually see, is there something here to do? No, there's not. You move to the next chart. And you only flag those ones that you're very serious about, or that you see a potential area like this. If you were there, then I would have seen, yes, I want to look deeper into this chart and monitor it a bit closely. But in this case, there's nothing to do, so we can skip on. So let's see what happened here. An uptrend, went for a couple of impulse waves, up there, down there, didn't cross it. There was a massive candle there, gave us an entry or a fractal there, went back. Problem with these moves is, let's have a quick look there. A massive space there, a lot of pips. If you look at the average wavelength, if you look at the average trend here, that's way above the average. So just to get break even, it's going to be a long time. And remember, we didn't know it's going to hit the first one. So based on those, based on the average length of these waves, that's just too much. I'm not gonna take a risk here. I'm looking for an easy one. Right. So we leave that one as well. Let's see what the market does. Okay, there's a downtrend. We wait. It breaks through, gives us a very nice fractal there, pulls back, and unfortunately pulls back through the 15. So we wait again. Could have continued, we don't know. So we're waiting for the early stages of the next trend. And This is one method that we're using to identify it. There is other methods. I already, let me show you quickly. Yeah, I mentioned the professor has got another one that's in uh, the recorded webinars that you can also watch. It's a little bit earlier than this one. So, but still, you must be able to see the structure. Can you see the structure here? There's the downtrend. There's the initial stages of the next trend. So let's look here. Goes through. So there's a ranging, a little bit of ranging there. Then it pops all the way back there. Doesn't pull back very much. So since I like to look at beautiful setups, I would have skipped this one as well. Right. So I'd like a pullback that goes a little bit deeper there. If you get somebody that says, no, I do like it, this is the early stages of the next trend, I'm willing to take that risk, because this is the first, if you look there, it's the first decent impulse wave. Let's see what would have happened. This is part of the training you have to do. You're going to play around until you figure out what is your risk profile, what is your risk appetite. Some guys would take this trade, some wouldn't, and the choice is up to you. All right, so let's see what happened here. We put our stop loss there at the 34. It triggered our trade, went back, almost took it out, but it didn't take it out. Buffling along there, it's still above the 34, so there's no reason to get out. Give the market room to breathe. Some trades are just not going to work out, right? And we know this. That's why we expect a net profit over a series of trades, not a win for every trade. It goes, touches our first one. Don't know if it triggered it. Touched it again, and obviously the trend is coming to an end. So if it didn't touch you there, then you know something is happening here, starting to breach this one. So you had a choice to either bring it to break even or to take the trade out here. I don't like to manually take the trade out. I like the market to take it out. So I would normally just move my stop loss. So in this case, when I see it's making a lower bottom here, I'll just move my stop loss to to under these ones, giving the market. If the market wants to go up, then I want to be up as well. But this point proved to me that the market is not sure. So I want to limit my risk at this stage. Right. So let's continue. So that one didn't go too well, but we didn't have a big loss in that one, or we didn't have a loss too big of a loss on that one. Right, and that's in the end what's going to make a big difference. So we're managing our risk very effectively. Right, let's see what happens here. Again, news or something, major breakthrough here. Pulls back, looks nice. Might have been, I don't really like that one. But it was a nice pullback, but it never went to the entry there. So it started trending up, so we leave it. Right. Normally in the workshops, when I do these practical ones, the guys tell me, but sir, why is there so few trades? Especially if you go like this on the historical charts. And that's the point. That's where a lot of guys miss it. They overtrade. It looks like a good trend. They haven't properly. They don't have a simple, well-defined method. They don't understand the foundation. They don't understand the sweet spots, the initial stages of the next trend. They don't understand it must be a simple, well-defined method with proper management, high probability money management, and then you have practiced over and over and over. Remember the quote of Bruce Lee that I said, one kick 10,000 times. You practice it over and over and over until you can see it, and that's one you take. So that is why a lot of guys blow up with overtrading. It's not well defined. They haven't practiced it well enough. And then if it looks like half a decent entry, they enter. And when it doesn't go their way, they get out too soon. That is the death trap, or part of the entertainment trap that kills a lot of traders, even very good ones. So, right, so let's go. Let's practice. We've got the same problem here again. We've got a lower bottom there, goes up. So that might be, this is going to be our first impulse wave, but it's too low. A lot of volatility there keeps us out of the market. Right. Here we go up again. Breaks through. Pulls back. Never reaches that. So if it went there, this could have been our entry. Again, large candles. It's up to you. What you will find, which is very interesting, is that some currency pairs, the fundamentals always stays the same. The foundation stays the same. But each candle or each instrument, currency pair, commodities, whatever instrument, it's got its own personality. And I know what happened with me is in the beginning you train on a lot of them and you filter the ones that you don't like. So especially and that not only goes for instruments but for time frames as well. I know guys that trade very well on very low time frames like 1 minute and 5 minutes and so on. I've practiced there, but I find that I don't like it so much. I go for a little bit higher ones. So, or I use the fractal principle, where I look for a nice movement in the higher time frame, and I go and look on the lower time frame for a trend and try to trend there. So I don't have to look at the lower time frames all the time. Right, so let's go on here. So here, some ranging market, nothing to do. Starts trending a little bit, comes back. Let's see what we've got here. Here we've got a breakthrough. We've got a pullback. We have a bit of a problem here. The 15 moving average is has not come through yet, but it is a nice breakthrough. So let's train our eye. Let's see what happens here. Okay, our stop loss is going to be at the 34. It goes through, takes our first take profit. It's a break-even trade and takes us out there. So we've lost nothing. This is the power of high probability money management. So if we wanted, for instance, if I wanted to make a lot of profit, at least 1 to 2, 1 to 3 with my with every trade that I take, that's a low probability type of money management. There's a low probability the market's going to give you a lot of money with each trade, but there's a high probability it's going to give you some money. It's going to move a little bit in your direction. This is a prime example of this. Other guys would have lost money here. Here we had no loss here. So in a series of trades, it makes a difference. Okay, so what happened here is we're out. Let's get out. We were taken out here, and now we're out. We wait. It breaks through. Not a nice pullback here. If it was a nice pullback, I would have taken that one, even though it was a long candle. But it was no decent pullback here, and there it goes. And again, even if you took that one, there's your 34, at least you had a break even there. So the power of high probability money management. All right, nothing there. Breaks through. Now there's one problem here. This is not a decent trend, right? So can you say this is the early stages of the next trend if it is still, if you're not even sure if that was a trend? A lot of guys would say no. Per definition, it's no, but it is fulfilling our it is fulfilling some of the aspects of our method. So let's see if we can check. There was our first impulse wave. There was a corrective wave. There was our second impulse wave and pullback corrective wave. But according to definition, the Charles Dow definition, to be an uptrend, it needs to break the second. There was our first top, second higher top. They need to break the second higher top. So our problem here, per definition, or if you look at the foundation, is we're not sure if enough buyers were committed to really to cause a new trend. So per definition, we left this one, right? The structure of the market gave us a good entry here, but because this was not a good uptrend, we rather leave it because we understand the deeper insight. We understand what it means, and the problem is if you're going to start making exceptions with stuff like this. Yes, we've got good money management, so it's going to help us. But if you start making exceptions, you start going towards the entertainment trap again. So the good traders, 1, 2, 3 methods that they trade, they stick to the basics. They stick to their well-defined method. So because it keeps them sane, it keeps them focused. Right. So what do we have? What have we got here? We've got a doesn't go lower there. There's a sort of impulse wave. That's not very nice. Second one, third one, fourth one. This is definitely qualifies as a trend. So here we can start looking again. Breaks through, doesn't give us a proper fractal there, wasn't a good reversal point, comes back there, and there it goes. So we missed this one because there was no fractal there. Right. There's an uptrend going. What have you got here? We've got a breakthrough, we've got a pullback, we've got a nice fractal there, and there we place our, that one's a bit close there. But still we follow our method, and there we've got a decent trade. 1, 2. Right. Can you guys see? Does it make sense? I've had some questions of guys saying, can't we automate the backtesting? Now, if you write algorithms and especially expert advisors and so on, yes, there might be some benefit for you there. But if you're busy training with a simple, well-defined method like this, and you're busy training your mental framework, it's best to do what you do. So you go to alt charts, you put in your indicators. Sometimes do just to help to help the guys to see is to overlay this as well with the trend line. Can you see the trends there? That's the underlying rhythm. That's actually what we're focusing on, the underlying rhythm there. And all our method is doing, our simple, well-defined method, is helping us to get involved in the market, to know exactly where to enter, exactly where to protect our account, exactly where to take our profit in this initial stages of the next trend. Right. So I'm going to bring it back to the basics the whole time. It's very, very important. If you can't see the structure, you're blind. If a guy tells me I trade when this line crosses that line, I know it's not going to last. He's got no understanding. He's got no root system. So it's very, very important. Okay, let's practice some more. There was an uptrend. We caught that one. There was a break again. Initial stages of the next trend. Goes up, goes down. Too much space there. Don't like that. In this case, you would have probably got your 2 to 1, but over a series of trades. Again, I'm looking at the average wave structure here, and that's a lot. That's a lot of risk to take there. The chances of getting to your first one, I did here, but it's low. I don't like that, so we left that one. Here we've got the early stages of the next trend. Bit of a range here. Breaks through. It pulls back. I like it. I like it. There's our break. Let's see. No. I missed it there. There's our break. That's not a decent pullback. It's pulling back past there. We leave that one. There again, goes a little bit lower, but there's no fractal there. So that's a little bit too wishy-washy for me. So it looked, when I looked quickly, it looked like a proper one, but it's not one that just jumps out. It's not an easy one. So we don't want to look too deeply for once. It must jump out of you. It must be an easy one. Otherwise, you start seeing stuff that's not there, and then your brain starts working in mysterious ways. And that's the type of trade afterwards. You just say, how could I have entered there? So luckily, what is true is if you at least know the fundamentals, you're looking for the early stages of the next trend, then the odds in your favor anyway. So if one got involved in this trade, which I wouldn't personally have, then at least you know it's the early stages and you have a good chance of managing your risk. but I didn't take this one, so let's go there. Okay, let's see what happened here. It's definitely a downtrend there. Breaks through, pulls back, and there was definitely a possible entry there. There's our 34, and it was never reached. Now the problem here was it went down, it didn't go up, so there was the first warning signal. If it's not a, remember what we have here. We have here a new impulse wave, sort of a corrective wave here. Impulse wave, we want the second one. So let's say that was not a nice pullback there. There's the first impulse wave, the first corrective wave. We want to enter into that one. When you start doing things like that, you get the market is warning you about a ranging market. So there, after that one, we would have pulled our trade there, right? Okay. Any questions so far? Let's see. Oh, we quarter two. We've got some time left. I think we've looked intensively about this in this one now. So I'm gonna, if there's no questions, then I'm gonna look at a few other ones as well. So some guys asked me the other day while we were doing a Skype session. He said, "Okay, but how can you be sure this works on any time frame?" And then I showed you, and I'll show you again. Oh, Frank. Okay, Frank. What moving average is that? This is the 34 simple moving average. There it is. And that's the 15 simple moving average. Right. You can go and watch that at the recorded webinars. There is an introductory one which shows you exactly how this works. Right, so let's go and look at a few other ones. As long as there's enough liquidity in the markets, then on any single chart you will look at, any single time frame, the lower time frames will more noise. Let's look at a few. Let's stay here. Okay, we're going to the 1 minute now, and let's zoom out a little bit so we can see our structure. What I'd also like to add here to help you to understand what's going on in these places is just to go to properties. You right click on your MT4, go to properties, and you put your period separators here. And also put your R line. It shows you what the spreads are. The low time frame spreads can be a problem. Right. So in the lower time frames, you will still see the structure. Can you guys see the structure here? There's an uptrend. There's the initial stages of a downtrend. We look at a couple of trades now. There's a downtrend. There's the initial stages of a uptrend. So there our method would have shown us something. There our method would have shown us something. We'll look at it now. But then you get certain periods on the lower time frames where it's just weird. Now, if you look at the time, this was 10 o'clock in the evening. This is when the New York session closed. The market's not totally closed. There's still people trading, but the huge numbers goes down. Right. You can verify this if we look at the grid or the volumes here. Here you'll see there's a lot of volume there, and here it goes down. So there's not a lot of guys trading there. So, and that's a warning sign. When there's not a lot of people, there's not a lot of liquidity, then these beautiful trends, they start becoming small and you get more erratic movements. There's still structure, you can still see structure there, but it's not it's not very easy to trade. So, okay, let's get rid of the volumes and zoom in a little bit. Let's see if we can get a few entries here on the 1 minute, even on the 1 minute. Okay, so what do we've got here? We've got a downtrend. We've got a breakout out of our 34. Beautiful pullback. We put our, let's zoom in a little bit more so I can, oops. We can show, and this is part of, you're not trading yet, we're not trading, we're practicing. We're building that root system, we're building our neural, like that neurological trees we talked about. We are training, we're acquiring a skill that will help us to be successful later. All right, let's see. There was a breakthrough. Don't really like that so much. There's a first, second. Okay, let's check. Breakthrough. There's our whatever. And There's our stop loss. Almost touches there, didn't touch. Go down. Wouldn't have liked it. Yeah, I probably would have gotten out there. But if you did leave it, it went there. Didn't like that though. That's one of the problems with the lower time frame. There's lots of more noise because there's less people involved in creating these. This represents 1 minute, 1 bar. So there's not a lot of people trading, or it doesn't represent a lot of people that was involved in the market in that 1 minute. In the higher time frames, there's less noise, right? But again, on the low time frame, there's more opportunities. So if you do train yourself, you own your skill, um, and you manage your risk tight, then it is definitely possible. I've seen lots of guys making a net profit over a series of trades using a proper foundation, proper method, using going for the sweet spots, right? But let's look at a few more examples. Okay, Frank asks, why do I use the SMA and not the EMA? Why use the SMA? Frank, I used it for a purpose here. This is just when I tested. This is a very good line with the tests I did. There's lots of you can use EMAs if you like. It's just that you must choose a method that shows you the early stages of the next trend. The combination you use, there's lots and lots of different combinations you use. What I had to do here is I obviously couldn't copy some of the other traders' ones, so I chose a strategy that shows me, or that helps you to enter on the second impulse wave. And I experimented with a couple of them, and a combination of these two and the moving average and the fractal just did it the best. So no one is better than the others, but for the purpose of the training I do here to catch the second, on average, the second impulse wave, I found the combination of 34 simple moving average and the 15 simple moving average, to be the best here. So the bottom line is again not to start studying indicators and experiment so much with indicators, and that's what I call entertainment trap, that you miss the whole point. In the end, what happens here is you must see the structure. If we take let's just go to naked charts here. Let's just delete this. The indicators must never distract you from what is going on here. We're looking at the early stages of an next trend. There's a trend. It's the early stages of a next trend. Zoom out so we can see. There's a trend. It's actually the noise makes it difficult, but there's also a trend. It's the early stages of the next trend, right? So that's our bottom line. Your method must just help you, simple, well-defined, to be able to enter somewhere in the early stages of the next trend. That's the purpose of the whole thing, right? If we go back and we put it back again, as you can see, this one is too close to price, so it's closer than that. But the purpose of that is to help you with to help you to see when it pulls back. If we put on the 34, the 34 again is a little bit further, and the purpose of that is to show you that then it's broken through the trend. So the combination of them, it breaks through 34, the trend has been broken. It pulls back to the 15. That helps you with the wave structure, and then obviously the fractal helps you to identify the turning point, the possible turning point. Right. What's going to happen over time, and it happens to a lot of guys, is they actually get rid of the the indicators. So you simply draw in, and you can even see that with your naked eye. You can see that structure. You simply wait for the early stage of the next trend, and you look for a proper, nice pullback that helps you to manage the risk, and you take the trades. So as you get more experience, and you to really stick to the basics, then at some stage you might decide, no man, these indicators just confuse me, and you get rid of them, and you start trading with a clean chart and just that's sweet spots. I like to call it sweet spots, right? The initial stages of the next trend. Right. Ignace, sorry I joined the webinar a bit later. How do I activate this indicator on the phone? I've tried and get a simple. On a phone, it's a little bit difficult, but there is a way. I've shown at the seminars and the workshops. I've shown the guys how. There is fractals is there on the phone. You have to just search for it, and obviously you can put in 1, 2, I think maximum 2 on the phone. It's a little bit difficult. It's an actual fact. I would suggest that that you get a computer to train. When you are very well, when you've trained it very well, and you can do it quickly, and you know you've mastered the technique, you've mastered the initial stages, the sweet spot is taking trades in the initial stages of the next trend. Then you can do it on the phone, but to train on the phone, I know on the web and the webinars, the seminars and the workshops, it proved to be quite difficult. So it's possible, but it's just easier with a bigger screen of a computer and the mouse and so on. So, but it is possible. Right, let's practice a few more. 1 minute, you'll see very noisy. So that's why I say for me personally, it's a bit difficult. So, but still, you can see the structure. Noisy, you can see the structure. Right. Let's go up to the 5 minutes, so let's say for 15 minutes. See what happens here. Again, we've got that dead areas. Those areas when the New York market's closed and it's before the Asian session, and here the Asian session starts. Let's see here, about 2 o'clock, the Asian session starts. You can immediately see the candles get bigger, and then the London session opens at 10 o'clock. Then you've got more movement there. Right, let's see if we can identify some trades here. First, the structure, always the structure. Looking for easy ones now. There was a down, broke up, huge movement there. Must have been some news there. That was, again, looking at the normal waves. That was not a very good move. No trade there. No trade there. One problem with the lower time frames is you have to sit in front of your computer. So, and when you sit in front of your computer, then you get decision making fatigue after a while. That's why in the smaller time frame, sometimes you get guys, they make profit in the morning and they give it back in the afternoon. So there's ways around that. I'll look at that in some of the next webinars where we go for the supply moving average strategy. Okay, let's see there. Huge candles there. No, stay away. In that case, you would have gotten some profit. Let's just see. But in general, no, it's way too way. You don't like that ones. That's actually trading a higher time frame there. That's not a very nice 15-minute move. If you go to the 30 minutes, you see it's probably actually a 30 minutes or even an hour type of a wave structure. Where is it? There it is. Yeah, there's actually more of an hour one. Right. So we're in the 15 minutes now. Let's see if we can see some trends. We can pick up some signals. Difficult, guys. Difficult. There's some movement there. It breaks, doesn't go below. Again, look at that break. It's 3 o'clock in the morning. It's not going to be possible. So in practical terms, normally in South Africa specifically, the guys trade during the day. We're lucky we catch the London Open. So that's from there about 9, 10. And then until 1, 2, there the London gets a bit sloppy, and then at about, I think it's lunchtime there, and then at about 3, 3:30, then New York opens, and we can get some 2-3 hours from the New York as well. Here was no decent trend or no decent setup here. A lot of guys say that's a problem. They want to trade every single day. Not a good idea. You trade only when it's the initial stages of the next trend. Remember, we're looking at one chart here with this method, which you can quickly see if there's a possibility or not. Then it means you can trade actually quite a lot of charts. I personally trade the ones that they use in the signals. It's about 14, 3 commodities, 3 indicators, and then The other ones are currency pairs that don't overlap, so you can go look at that if you want. But I know guys that even trade up to 30 charts. So, but you have to have mastered a very simple, well-defined method to be able to do that. You quickly scan through those charts, and you just mark the ones that you see potential, you have potential, and you focus on them. So it is possible, definitely. Let's quickly see here. We didn't like that one. Wasn't a decent trend. There was a decent trend. Broke through, pulled back. There was definitely a trade for practice purposes, practical purposes. For practice purposes, it broke through, pulled back, and went up. But again, 3 o'clock in the morning. So who's going to trade then? Okay, lots and lots of noise. Let's go a little bit up. We just get some other perspective as well. Right, an hour. If I take away the what it is here, then you won't be able to see. When you get more experienced, you can see if it's a lower time frame, there's more noise, but you can't see which higher time frame one is it, because the structure stays the same. Right, let's see. We've got some noise there, keeps you out of the market. Went down there, too much noise. There was a nice-ish one, went down, lots of pullback there. I don't know. Don't like that much noise there. Let's see what would have happened if we took that one. It's always good to test, remember? If we test a couple of them as we go through our historical charts and we can see what happened or not. Are we willing to take the risk or not? Our entry would have been there. Our take stop loss would have been there, which is very tight given that. So that's the method. Let's see what happened. It engaged us and immediately goes up. So it would have been a loss there. So as you practice and you get these structures, you realize it's not worth it. So let's rather skip those ones with lots of volatility there. Okay, again, zoom out a little bit. It's 4 o'clock. So I'm going to look at one or two more. There's a downtrend, a break, not a nice one there. There it breaks, pulls back, there's no fractal there. Breaks, nice fractal there. There's a possible trade. Hope you're getting that idea. There was a nice one. Got us there and immediately gave us some profit within 2 candles. Right. So that's the type of setup we look for. But once it's nice and clean, easy to see. Let's see if there's some more questions. Anybody that wants to review this can just email me. Let's go to that. Where my email is. Oops, daisy. Okay. Get to the questions now. Here's my email in case anybody wants to email me, and I can send you the link to this one if you want to watch it again. Right, what is the best session to trade between London and New York? I think that depends, Richard, on where you are. Both London and New York are very good. I know the guys with London say with London you get a little bit more. You get from about 9, you get 3, 4 hours, 5 hours worth of trading. With New York, most guys say 2, 3 hours, then the volumes drop. So that's the difference between them. I know guys that trade even the Asian session, obviously stay in Australia and so on. And if you've got the basics, your foundation is right, you're looking for the early stages of the next trend, then you can actually trade any of those sessions. You must just test it very well before the time, so that you can you hone your skill to look at those, get to know the personalities of the pairs that you trade, and choose the ones that you like best. It gives you those beautiful initial stages of the next trend. Right. Can you elaborate for me on the rollover policy? Um, Rollover policy, I think that's the best. I do more training, with the charts and so on. Those technical things is best, Ignace, if you ask your account manager. So, right. This is the first time I've seen a Fibonacci that has a take profit and a stop loss indication. Frank, yes, we changed it. So it's not it's not, it's a custom one. So it is definitely not normal this way. So we changed it, and it stays this way until we decide we want to change it back, or uh, we can go to defaults there. And if you set the defaults, it will go back to the normal defaults. But you can change it, and that's just what we did. Okay, and it's basically we just use it as guides to help us with to see where our take profits is going to be, would have been, and so on. And especially when we start trading, I'll do that in some next webinars where we go to the 1 minute and we take some trades where we take partial profit. Then it helps you because we've got with the take profits and so on, we've got the price here. It helps you to put the stop orders in very quickly. So it's a useful tool, this Fibonacci. Okay, these SMA lags a bit behind the candles. So how can we avoid fake outs? Mustafa, there's no way to do that. The method you choose, like I said, there's a method. Let me just quickly show you that as well. The one I chose, like I said, is the a one that uses that catches the second impulse wave, but there is one that catches the first impulse wave. And the head of our education department talks about that one. That's his baby. If you scroll down in my FXTM education webinars and you scroll down, there's lots of useful things to look there. For instance, Japanese candlesticks. There's also, I see some guys starting to trade, but they haven't mastered it. They don't know how to use MetaTrader very well. So there's a couple of webinars here also that can show you, that gives you some understanding on how to use your MetaTrader. Right, this is the one. It's ultimate trading formula. If you listen to that, then the head of our education department will explain to you. This is where you catch the first impulse wave. Right, a little bit more risky, but depends on you. It's the ultimate trading formula, and his money management is just a little bit up. Fibonacci strategy explained. So you're welcome to do this. What we want to give you is we want to give you the understanding of what technical analysis is. Remember that sweet spot, the initial stages of the next trend. And then we want to give you an option of a few strategies, simple, well-defined strategies you can use to master this. And if you master, you need one simple moving average, guys. And to master that, and then you can get your cash flow going. This is a business. This is not an entertainment thing. That is the reason why so many guys bomb out their accounts. They use this as a form of a gaming or entertainment platform, and that's not what it is. This is a business. This is a micro business, very small overheads. And if you understand the foundations, you understand that sweet spots. You've got one simple, well-defined method, like the ultimate trading formula here for my simple moving average spring strategy one, and you master it. Then you will make a net profit over a series of trades. You can build up your account, and you must just be patient and trained. So it's possible for anybody. Right, I think we finished. Like I said, the last thing, if you want to, you can email me. If you want to have any questions or you need some support, then we can make an arrangement for a meeting via Skype as well. I train a lot of people just to get off the ground. That helps a lot. So talk to somebody to help you get the basics, understand the basics very well, and practice it. And, right. Okay. Thanks for listening, and hope you have a nice week.